In today's video, I'll be exposing the dangerous 401k lie that's fooling millions of Americans into believing they're making retirement progress when they're actually falling behind. Through analyzing Fidelity's data from over 50 million retirement accounts, I've discovered a shocking disconnect between what people think retirement success looks like and what actually creates financial security in retirement. That's exactly why I'm making this video today, to reveal the lie that record high savings rates means retirement readiness. Why Fidelity's data shows that this assumption is dangerously wrong, and what you need to focus on instead to create real retirement security. If you're new to the channel, my name is Ben. I've been a financial advisor for almost 20 years, and I want to help you have an even better retirement. So Fidelity's latest retirement data shows something that on the surface sounds like really great news. Total 401k savings rates hit a record of 14.3%, with employees contributing 9.5% and employers contributing 4.8%. That's the highest rate we've ever seen, and it nearly matches Fidelity's recommendations of a 15% total savings rate. But here's the lie. These record savings rates are being treated like a victory lap, as if this one number signals that we finally solved the retirement crisis. Financial headlines are celebrating, plan sponsors are patting themselves on the back, but what we're really doing is confusing effort with outcome. Fidelity's own data quietly tells a different story than the headlines. Despite these record contributions, most retirement account balances either were flat or only growing modestly. And the only group seeing meaningful growth, well, those are 5-year continuous savers. Those balances rose over 20% over the last year. So in other words, consistency wins, not one-off contributions. So if savings are up, but balances aren't reflecting that, there must be some kind of a disconnect. And here's what I believe it is. People aren't investing efficiently. They're either picking the wrong investments or they're changing their investments too frequently. Instead of low-cost, globally diversified ETFs and index funds, the type of investments that build wealth slowly and predictably, too many investors are chasing hot sectors, they're paying really high fees, and they're trying to time the market. That's a recipe for burnout and underperformance. And the truth is, retirement investing isn't about finding the next big winner. It's about building durable wealth. That's why I teach a 3-step foundation for long-term retirement investing. Buy the best companies on earth, which are already pretty conveniently bundled inside diversified index funds and ETFs, which are found in most 401ks and IRAs. Number 2, own them as cheaply as possible because high fees are basically an unnecessary drag on your long-term investment returns. Most investors don't realize that the less expensive funds do just about as well, and in many cases better, than their more expensive counterparts. And you might say, hey, you get what you pay for, but I don't think that always applies when it comes to investing. And then number 3, own your funds as long as possible. Don't chase returns. Don't jump in and out of the market. Don't try to time the market. Don't try to outsmart the market. Buy with the intention of never, ever selling other than periodic rebalancing and collecting your monthly retirement income. So to recap, own the best companies in the world, own them as cheaply as possible, and own them as long as possible. For me, that's the foundation of retirement investing. It's really simple. Admittedly, it is painfully boring, not at all exciting, but it works. And really, that's the most important part. Too many investors are still stuck in that performance chasing cycle. I'll give you an example. Many people went overweight U.S. stocks because international had a pretty bad decade and underperformed. But then in 2025, when international finally outperforms, now they're selling U.S. equity to try to chase those international returns after they already ran up. That's really not a solid strategy. That's just emotional investing. And it's going to cost you pretty dearly, I think, in the long run. Buy and hold is by no means mistaken for a sexy investment, but it is powerful. It's easier, it's less stressful, and I think it's more effective in the long run. And when it comes to managing risk, timing the market is not the answer that you're looking for. It adds anxiety and it hurts your investment returns long run. And really, that's a lose-lose situation. Instead, I'd like to see you use tools like retirement income guardrails, right? What's your plan to temporarily reduce your portfolio income when the market gets particularly bad? This kind of strategy allows you to spend significantly more than a lot of the safe withdrawal rates you'll hear about on YouTube and in podcasts. Separating growth and income buckets. Now, this one's pretty easy. If you're retired or you're getting close to retirement, just don't have all of your money in the stock market. Stocks for growth, that's fine, but bonds and cash for monthly income. The perfect retirement portfolio really has both. If you'd like a visual aid of the perfect retirement portfolio, picture the mullet haircut from the 80s, right? That was business up front and party in the back. Well, the business up front, that's our bonds and cash, right? We know exactly what to expect for the most part. The party in the back, that's our growth engine, right? That's our globally diversified basket of low-cost stocks and index funds. Business up front, party in the back, right? We take our portfolio recommendations from Joe Dirt. The retirement runway strategy is our third option. We're probably using all 3 of these at once. And that's simply take our desired retirement income monthly, divide that number into our portfolio's bonds and cash, and that determines the length of your runway. Another way to think of it is how much railroad track am I laying out in front of myself in bonds and cash, not in the stock market. Now, for some investors, that could be 3 years, it could be as much as 7 years, maybe 10 years, depending on the structure of your portfolio, what your income goals are, and your appetite for risk. Now, these tools manage your volatility and risk without sacrificing market performance. And the best part is they're absolutely free. Totally free. Anybody watching my videos or listening to my podcast can implement these ideas for no cost at all. Now, yes, we could and should celebrate higher savings rates, but let's really not be fooled. The real key to retirement success isn't just about saving more, it's about investing better, paying less, and sticking with our plan. So now that you understand this dangerous retirement planning click the link in the description below. You can book a call with me, and I'll analyze your specific situation and show you how to optimize your retirement plan as a whole. Now back to Fidelity's data. Behind all the celebration, Fidelity's data reveals a deeper problem. Account balances just aren't keeping up, even when people are saving more than ever. And here's what the numbers actually show. Long-term retirement account balances dipped slightly last quarter despite record-breaking contributions and a pretty good market year over year. And that's really the gut punch. Americans are doing exactly what they're told to do, saving more, but they're not really seeing real progress. Now, why is that? Well, I think it's because the market doesn't reward effort alone, it rewards sound strategy. Market volatility can erase the benefits of even the most disciplined savings habits if your plan isn't built to withstand the often bumpy ride that comes with investing. And this creates a dangerous illusion. People believe that they're making progress because they're working harder and they're saving more. But if account balances are shrinking while contributions are increasing, that's really not progress. That's a disconnect, and that's what I think it is. You could be doing everything right on paper, saving consistently, avoiding lifestyle inflation, and still end up unprepared or underprepared for retirement if your investment and future withdrawal strategies aren't properly aligned. Effort without outcome isn't a plan, it's just a recipe for more frustration. Understanding these behavioral gaps helps us uncover what actually creates retirement security, and it's a lot more than just contributing more money to your accounts. In the military, we would call this strategy accuracy by volume. And it might work pretty well on the battlefield, but in your retirement, I think you want something a little bit more scientific. At this stage of the game, strategic asset allocation becomes more important than your contribution percentages. You can hit every savings target, and you can still fall short if your portfolio isn't designed for your specific retirement income goals and flexible enough to adapt as markets change or as your retirement income needs change. And that's really where risk management comes in. Market corrections aren't rare. They're inevitable. They're going to happen eventually. If your plan doesn't account for that volatility and it's just built on hope, that's really not a real strategy. And Fidelity's data could not be more clear on this issue. Contribution rates alone don't create retirement readiness. That can only be found through proper planning and risk management. So why is it then that so many retirement plans fail? Well, they focus too much on accumulation, how much you've saved, and they ignore the actual mechanics of retirement, like how are we actually going to spend this money? How are we going to turn the savings into income that we can have fun with? Right? How you'll maintain that income through difficult times in the market, how you'll reduce taxes on all those IRA withdrawals, right? Real retirement planning isn't just about portfolio growth. It's about coordinating everything that happens in your retirement life, right? Savings, investments, income. How do we collect our Social Security and pension, and when do we turn them on? Taxes, risk, and then finally, most importantly, our own personal behavior. So how can you build a retirement plan that survives volatility and delivers real lasting wealth? Start by shifting your focus from contribution rates to total retirement performance. Develop a strategy that can align with your long-term goals, matches your risk profile, adjusts to changing market conditions, then build a plan that holds everything together when the market doesn't. Real retirement security comes from the coordination of aligning your savings with your investment strategy, aligning your investments with your withdrawal plan, and then finally aligning your withdrawals with a long-term tax strategy. Anybody can save money, but not everyone creates a system that turns savings into reliable, predictable retirement income. A great retirement plan isn't just about big numbers in your portfolio, although that is fun and we celebrate it. It's really more about having a structure that you can actually stick with for a 30-year retirement. So now that you understand the dangerous lie that high savings rates equals retirement readiness, you can start focusing on what really works, building real retirement security that protects your future regardless of market conditions. And if you want help creating that kind of a strategy, one that goes beyond contributions and actually works in the real world, click the link in the description and book a call with me directly. I'll analyze your specific situation and I'll show you how to optimize your retirement plan as a whole. Savings, investment, income, taxes, the whole thing. So thanks for watching. My name is Ben. I hope this video helped to make your retirement even better, and I'll see you in the next one.